that we have that each state has its own tax rate and its own wage base. And so, yes, this is what it would look like for an employer in Iowa, but if that employer was in Hawaii or in California or someplace like that, these amounts would look a lot different. What the amount that would be taxed would look different. What that wage base is would look different. We already looked at all of that, and the chart that's in the where am I here? That's in the textbook. Oops, I lost my spot. We can kind of go through this. This might be a good example for both FUTA and SUTA. So we've got this company, Sumatra Imports, based in New Mexico. So we would look at what the New Mexico wage base is and calculating what the New Mexico tax would be. They have a tax rate of 4.2%. Their taxable SUTA wage base is $31,700 for each employee's earnings, so a little bit lower than Iowa. During the year, they had FUTA taxable wages of $109,500, SUTA taxable wages of $298,700. That makes sense because that wage base is, about 3 times higher. So that's why their taxable wages are about 3 times higher. Compute the amount of FUTA tax. So for the FUTA tax, again, our base times our rate. Base $109,500 times the 0.6%. So $657 is what they're going to pay in FUTA taxes. For SUTA taxes, significantly higher amount because both our base and our rate are higher. $298,700 times the 4.2% for a total tax of $12,545.40, which would have been paid throughout the 4 quarters of the year. So just kind of showing the difference between that FUTA and SUTA, both the base and the rates, and how that impacts then the ultimate tax liability. Let's start talking. There we go. We're going to start talking about this experience rating. I need to erase this because I'm going to need some space. So what happens is each state puts the contributions from all employers into one pooled fund, but they keep track of how much every employer has contributed and how much in benefits each employer has paid out. And their ultimate rate, tax rate, is going to be determined by a ratio that includes in calculating it, it includes the contributions and the benefits, and then we divide it by the average payroll over a set period of time. That set period of time may be 3 years, maybe 5 years. It's whatever the state uses to determine what that average payroll is. We take those amounts, arrive at what's called a reserve ratio, and then we use that reserve ratio and apply it to a table that is determined, that is set up by the state unemployment agency as well, and in order to determine what that rate is. Now, this is all done by the state unemployment agency. It's not done by the payroll professional, but it's good to understand how it works because that ultimate tax rate is important to the business. The higher that tax rate is, the more that's going to be paid in taxes. And there are ways that employers can lower the tax rate by making, well, the only way there's 2 ways that they can really do it. They can increase their contributions or they can decrease their benefits that are paid out. Now, they don't have a whole lot. They have some control over that in that they can fight when somebody files a claim, an unemployment claim, which is why they do that, to fight those claims, because it affects their reserve ratio. Anytime an employee makes a claim against a company for unemployment benefits, it is going to negatively affect their tax rate. By negatively, I don't mean the tax rate's going down. I mean that the tax rate is going to go up and they're going to pay more in taxes. So what they have control over, well, they could also control their average payroll, but they made, that's probably not the wisest tactic for affecting the reserve ratio. The most control they have over are the contributions that they make. If they make additional contributions, it can lower their tax rate. And in certain scenarios, it may benefit them to make an extra payment, but then pay lower taxes the next year. It may net out a greater benefit to the company to do that. So that's what we're going to go through here, is a problem that involves figuring out what this reserve ratio is, calculating what the contributions are and the benefits paid, and what the average payroll is, and then what the resulting tax rate is going to be. Like I said, you have a homework problem. The one that I'm going to go through may have different numbers than yours. So it may not be exactly the same, but all the concepts and the steps are the same. So we're going to pull that up here. Somewhere. Oops, I timed out. Take me just a second to pull up the right problem. All right, let me see if I can find it. What? There we go. All right. Oh, actually, this one's a little bit more advanced. Let me see if I can find oh, I guess we can do that one. I like the other one better though. Hold on a second. I might have to regenerate this to find the problem that I want. All right. Oh, was it the same? This is it. Okay. This is the one I want to look at. All right, here we've got Carlson Software Company, located in State H. Employers can reduce their contribution rates under the experience rating system. So that means that they can make additional contributions in order to reduce their ultimate tax rate if they want to do so. So from 2011 through 2024, the company's total contributions to state unemployment amounted to $14,695. All right, so from 2011, so we're looking at contributions. In order to determine, so what we're trying to do here is determine what our reserve ratio is. To determine that, we have to know what our contributions are, what benefits have been paid, and what our average payroll is. Okay, so first thing we're going to try and do is determine how much has been contributed. How much in tax have we paid over the years? So, let's see. So from 2021 to 2020, I'm sorry, 2011 to 2020, they've had contributions of $14,695. All right. For calendar years 2021 to 2024, the contribution rate was 2.7%. We're going to have to calculate what the contributions were for those years. So that's why they're giving us that information. So 2021 to 2024, we had a 2.7% contribution rate. The contributions of each employer are credited to an account maintained by the State Unemployment Compensation Commission. The account is credited with contributions paid by the employer and then charged with unemployment benefits that are paid. So contributions go in, benefits come out. Starting January 1st, 2025, the contribution rate for all employees is based on the following rate schedule. So what they've got here is a table showing that depending upon what the reserve ratio is, that will determine what the contribution or tax rate is. Contribution rate, tax rate, same, they mean the same thing. So in order, we have to come up with that reserve ratio to then determine what our contribution rate is. The annual payroll for calculation purposes is the total wages payable. So now, okay, so we're going to have to determine we know what our contributions were for that decade. We're going to have to determine what our contributions were for these other 3 years. They've given us the information to calculate that, but we do have to calculate that separately. We also have to determine what our benefits paid were and what our average payroll is. This defines how we determine average payroll. Annual payroll for calculation purposes is the total wages paid during a 12-month period, ending with the last day of the third quarter of any calendar year. It would start with the fourth quarter. So when they're calculating average annual payroll, what they're doing is they're starting with the fourth quarter, and then they're going to the first quarter of the next year, second quarter of the next year, third quarter of the next year. That's 1 year. That's what they're saying there. That the 12-month period ending with the last day of the third quarter, starting with the first day of the fourth quarter. Average annual payroll is the average of the last 3 annual payrolls. Okay. SUTA tax rate for the year is computed using the information available here. The schedule shows below the total payroll and the total taxable payroll for the calendar years 2021 to 2024. Unemployment benefits became payable. Oh, it's a little bit big. Unemployment benefits became payable to the company's qualified unemployed workers on January 1st, 2021. Between that time and September 30th, 2024, right here, total benefits amounting to $15,100.90 were charged. They've given us this factor. They've given us the benefits paid. Okay, so let's write that down too. And this is from 2011 all the way through September 30th of 2024. 15,000, what did we say? 190. Okay, so we don't have to calculate that. They've given it to us. They want us to figure out what the contribution rate is going to be for 2025, which means we have to figure out what our reserve ratio is for 2025. Okay, so let's do that first. In order to do that, we've got to figure out what our contributions are. We have our total payroll column here and our taxable payroll. Remember, we already know how much in contributions were made up to December of 2020, but we got to figure out how much we contributed for these other 3 years and 3 quarters. How do you think we would do that? How do we know, what factors would we need to know to determine how much we paid in tax, in unemployment tax? We've got our base times our rate equals our tax. We've got our rate. How do we determine what the base is? So every quarter we are calculating how much tax we owe. What number are we using to use for the base each quarter?
I don't know why. It's not 32, right? I don't know why. Or 7,000. Is that what we're talking?
I'm just asking in general, like what number would we use? What information would we use? So remember, we've got our base times our rate equals our tax. Well, our rate is right there. They gave that to us. So each quarter, we've got our quarters up here. Where would they get that information?
Oh, from the 12,000, the total payroll for
taxable payroll. Exactly. So what we need to do, our base here is our taxable payroll. So what we have to do is determine what's our taxable payroll for that period that is unknown right now. And we want the total taxable payroll. And this will tell us how much we paid in tax. So we're going to add up all of these taxable payroll amounts, and then we're going to multiply it by our tax rate, which they gave to us. So let's do that. Let's see. This is in the way.
only in the first quarter, correct?
No, we're going to take everything because we need to know from 2021 through 2024, how much have we paid? How much have we contributed? Okay? So So this was our taxable payroll from 2021 through 2024. I come up with 175,600. Is that what everybody came up with? All right, so 175,600. That's the total amount of taxable payroll. We don't want to take the total payroll because we didn't pay tax on the total payroll, right? There were amounts. There are some months here, like in 2023, we had total payroll of $12,750, but the taxable amount was $12,700. So we want to make sure we're using the taxable payroll. So that's what we're going to multiply by the 2.7%. $47,4120. So from 2011 to 2020, we made contributions of $14,695. From 2021 to 2024, we made contributions of $4,741.20. So we need to add those two together to determine what our total contributions have been. Okay, so we're going to add this down here, $14,695. Again, these are our total contributions. 19,436.20. Check my math. So we've contributed to, we've paid tax, unemployment tax, state unemployment tax, in total of $19,436.20 since we started. We've had benefits paid out of $15,190. So we paid in $19,000 some. They've paid out $15,000 and change. That's good. We've got a positive balance in the account. We've paid in more than has been drawn out. That means maybe maybe our tax rate will go down. Who knows? We'll take a look and see. So now we've got, of these factors, we know our contributions and we know our benefits paid. We've got to determine what our average payroll is. So remember what they told us. They defined average payroll up here for us, the total wages payable. So our total payroll, now we are going to look at this total payroll column. And we start with the fourth quarter and end with the third quarter. And that's a year. So we go from October 1st of one year to September 30th of the next year. And that is 1 year. So this would have already been, these months would have already been included in 2020. We don't have to do that. We need the last 3 years. 3 years, whoops, I'm kind of covered up here. Can I make this smaller? Come on. I can't make it smaller. So 3 years, if we work backwards, 1, 2, 3, 4. There's 1 year. 1, 2, 3, 4. There's 2 years. 1, 2, 3, 4. There's 3 years. So we're going to start with the third quarter of 2021. All right. So 2021, 2022. Well, actually, we're going to start with the end in mind here. We're actually going to do 2022. 3. We're going to total up our payroll, and then we're going to average it over those 3 years. So let's take a look. We've got, for 2022, this would be the year ending in 2022, payroll $13,000, which I'm getting from there. I'm going to add this, 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 and this. $48,250. This is, so here's our total payroll for each of these years. Next year is $12,500, $13,000, $12,750, $12,200, $50,450. Does everybody see where I'm getting these numbers from? Okay. 14,000 plus 10,000, 9,300 plus 9,350, 42,650. I'm going to add all those up, and then I'm going to divide by 3 to get our average. $141,350 divided by 3 years, so our average payroll. $47,11667. All right. We have all 3 factors. We can figure out what our reserve ratio is. We have our contributions here. So let's do a different color, shall we? contributions, we have our benefits paid, and we have our average payroll. Now we can do the math. So we'll take, I'll pull this over. It starts to get a little bit hard to see. So contributions, whoops, 19,436.20 minus, benefits paid 15,190 divided by 47,116.67. See if that's any easier for you guys to see. Now we just do the math. Whoops. Yes, it's in the problem. So 43, did I get that right? 19,436.20 minus 15,100. So 4335.3 divided by 47,116.67. 0.092. This is our reserve ratio. Now we use that and apply it to the table that they've given us. 9.2%. So contributions, if this was a negative number, this would be a negative number if our benefits paid out was more than our contributions that were made. Then we would come up with a negative number. That means we're in the hole. We've had more benefits paid out. That means that other companies' contributions are paying for our unemployment benefits for our employees. We're going to have to pay more. And you can see that's reflected in the contribution rate. Your taxes are going to go up as a result of that if it's negative. If other people are supporting you, other companies are footing the bill, helping to foot the bill for your unemployed employees, your rate's going to go up, right? And that's what that is. But this is a positive. So 9.2 is between 8% and 9.9%. Our contribution rate next year is going to be 4.5%. Okay. We'll verify that down here. Yes. Several steps to this, right? But essentially what you have to do is you've got to determine what each of these factors is in this equation to arrive at your reserve ratio, and then use that to find out what the contribution rate is. Now, there's a second part to this problem, and I'm going to add a third part just for fun. Now, actually, because the other problem is that I had pulled up is going to take you through this third part. So that's why I'm going to add that to this problem. Okay, so the second question here. What would the rate for 2025 be if $2,000 of additional benefits had been charged by mistake? And it doesn't really matter that it's by mistake. If they had $2,000 more of benefits paid to their account, or benefits paid from their account. So what would that do to this equation if $2,000 more had been paid in benefits? Yes, exactly. This would now be $17,100. This would increase our benefits paid by $2,000. So more is paid out. We're still in positive territory, but it's going to change this number. 0.049. All right, so now we look at the table. So now that changes our reserve ratio to 4.9%. And you can see that then increases our contribution rate to 5.5%. So our We had more benefits paid out that increased our rate. So now next year, we're going to pay more in tax, right? We're going to pay more in unemployment tax. So the third part that I want to add to this is, like I said, employers can make voluntary contributions, extra contributions, to reduce their tax rate. So let's just say, let's stick with the original amount here of $15,100 and go back to the 9.2. Let's say we wanted to, so that makes our rate, our tax rate, our contribution rate 4.5%. Let's say we wanted to get down to 3.5%. We want a 1% reduction in our rate. Let's say we think that our payroll next year is going to be $50,000. If our payroll next year is $50,000 and our contribution rate goes down by 1%, we're going to save $500 in taxes, right? So we've got, so we are projecting $50,000 in payroll for 2025. If our rate stays at, or I'm sorry, are we right now 9.2? Yeah, we're at 4.5%. So if our payroll, taxable payroll, is $50,000 at 4.5%, we're going to pay, what, $900? No, $2,250. Where did I get $900? So we're going to pay $2,250 in SUTA tax. If we can go down, get that down to 3.5%, we're going to pay $1,750 in SUTA tax, which will save us $500, right? Our tax went down by $500. Now, instead of $2,250 that we're going to pay, if we can get that rate down to 3.5%, we're going to save $500. But it's going to cost us something, right? We're going to have to make an additional contribution in order to get that rate down to 3.5%. Is it worth it? Is it worth it? If it's less than if it costs us less than $500, then it's worth it. If it costs us more than $500, it's not going to be worth it, right? So to determine that, what we can do is you're going to have to think back to algebra 1, not algebra 2, but we've got an X. We've got an X factor. Just one X. I won't add a Y and an R and all that stuff. So in order to get down to 3.5%, we need that reserve ratio to be at least 10. Right? So, but we don't know what our total contributions need to be. Well, we know what they are, what they have been. We want to know how much more we have to contribute to get this down to 10%. So you just do the math. All right, so what's the first thing you do? We're going back to 10th grade here. What?
So take 47, 11667, multiply it by 10%.
Yep, we got to multiply both sides of this equation by the 47,11667, right? So 471167 equals x minus 15,190. All right. Now what do we do next? To get x. Can you see that? Yes. We're going to add 15,190 to both sides, which just makes this x, and 15,100. 19,812.57. Okay, so our contributions, in order to get that tax rate down 1%, our contributions now have to be $19,812.57. Did I do the math right? Our contributions right now are $19,436.20. We're going to have to make an additional contribution to make voluntary contribution to get it up to $19,812.57. So we need to know the difference between these two. So what is this? Well, wait a second. So I'll do it on here. 19,436. 20. This is our additional contribution that we have to make. 376.37. So if we pay an additional $376.37, we will save $500. So we'll net about 125 bucks. Whether it's worth it to do that or not, we can assess it. You know, if our payroll was larger, it would be a larger difference. It would be a bigger difference.
And that rate doesn't carry on to the next year. It's a new rate every year, right?
It would be a new calculation every year, right? And we have to estimate, we're estimating what we think our taxable payroll is going to be, right? So the higher this estimated payroll is, the higher our payroll is, the more of a difference there's going to be, right? So if we think we're going to hire a bunch of new people next year, it would certainly be worth it because it's going to increase, this number is going to go up. This number is going to go up. Our tax savings is going to go up because we're going to save 1% of that. Questions? It's kind of fun.
Where'd you get the point one?
The point one, I got it from here. So we need this reserve ratio to be at a minimum 10% in order to get into the 3.5% range. Yep. Other questions? All right. So that's kind of fun. Let's see. We got 20 minutes left. Let's look at the Form 940.